The U.S. consumer just reached its breaking point, and what happens on Tuesday threatens to send the U.S. economy and stock market crashing. Because on Friday, we got the University of Michigan U.S. Consumer Sentiment Survey, and it's now dropped to its 4-month low. But the big issue here, my friends, it's on income worries. And this is a major problem because what this reflects is a cost of living crisis. And in these cases, you have real income that's inflation adjusted. Those expectations are now pushing historic lows, and a lot of people, this is remnant of the 1970s and 1980s inflation era. Now, the risk we've been talking about in the last couple of shows is rising delinquencies and the risk of a subprime crisis that could explode into an all-out financial crisis. But when you see confidence crashing, and this is a key point, it leads to less spending. And what this is telling us right now very clearly, that second half rebound in 2025 that companies and consumers and everybody around the world was betting on is highly unlikely to happen. Let's take a look at some of the numbers because the final September sentiment index dropped to 55.1 from 58.2 a month earlier. And while what we're facing is consumers are still expecting prices to rise at an annual rate of 4.7% over the next year. So what you have is two issues here. Is consumers are worried about their job, but it's about their income because they already realize that their dollar isn't going to go as far. Now we know inflation is unlikely to keep rising because the problem is demand is dropping faster than businesses can raise prices. But the reality here is we look to the holiday season, all of those surveys that keep telling us that consumers are going to spend less. Well, if the labor market goes, what it means is they're going to be spending far less, and this whole situation could quickly spiral out of control. Let's take a look at this chart of U.S. consumer sentiment as it falls to its lowest level since May, because we saw it in the data. If you remember back, we talked about this the other day, that the economy started to roll over back in April, and what you're seeing here on this chart is sentiment is lagging that, now peaking somewhere around June and July. And in the interviews this month, they highlighted the fact that consumers feel pressure from both the prospect of higher inflation as well as a weaker labor market. And there is a strong relationship between consumer sentiment and the labor market, and that is a big problem that we've been warning about it. And one of the issues here is why sentiment declined amongst all income groups. It held steady with those for a larger portion of stocks, and for good reason, because stocks are sitting near their all-time highs. But the problem is only about 10% of Americans own about 90% of the stock market, and what you're seeing here, my friends, is a huge wealth divide. So as we see the lower income groups fall further and further behind, it's rippling up into the middle class, and there's even some higher income people that are being affected here. But as we talked about, sentiment leads declines in hours worked. Let's take a look at this chart of the University of Michigan versus average weekly hours of production and non-supervisory employees. And I want you to see very clearly here that the issue we're facing is this relationship. As you see sentiment in blue decline, it means average weekly hours are likely to continue to fall. And you can see this throughout the cycles. And that was something I warned about a couple months ago when we saw the sentiment data crash. And what this is telling me very clearly is we're about to see hours worked drop in a major way. And this would be consistent with what we're seeing in the PMI reports, saying that new orders are collapsing, that backlogs are almost worked through. This is something that workers are seeing in real time, and now they're reacting to it in the sentiment survey. But it's not just the labor market, it's the stock market that's at risk here. And right now, most people believe that the stock market's only going to melt higher and continue its big bull run. The problem is, when you look at the relationship between the equity markets and sentiment, it tells you the opposite about to happen. Let's take a look at this chart of the University of Michigan versus the NASDAQ 100, with the sentiment survey still in blue. And you can see going back into recessions that collapses in sentiment lead a collapse in stock prices. Again, it has everything to do with consumer spending and profits. And you can see it happen going into 2022. And now we're at a big inflection point. You can see sentiment collapsing. Everybody says that companies are going to be rolling in the money. The problem is, if consumers don't spend, that can't happen. Now, I want to give you an update on a recent trade on DAPP, and I want you to see just how easy it is to make money in the markets using our system, because our subscribers got stopped out yesterday for a 21.12% gain. And again, a lot of people require you to sit in front of a computer and trade, but we give you risk control levels and we update them along the way, making this so easy for you to make money trading. And it's going to get even easier because we just rolled out yesterday our enhanced meta strategy. And again, my friends, we're changing the game when it comes to the way people trade. Stay tuned to the end of the show for more information, or to sign up now, grab those links in the description below. Be sure to use a coupon code for your free 30-day trial. But the real issue here isn't just the present conditions that consumers are saying are getting worse. It's the forward-looking data, because as we look out 6 months on the economy, consumer perceptions are getting worse. In fact, those conditions, at least as of today, now dropped to 60.4 from 61.7. But the expectations index, again, this is the forward-looking indicator. This is the one that matters as we look at the economy and determine, are consumers going to rebound here? It's now dropped to a 4-month low. That's 51.7. So again, this is a dangerous indicator, because what it's telling us very clearly is that consumers are highly likely to cut back on their spending. Now, I want you to think about this from a business perspective. They're sitting on a whole lot of inventories. And you think about the manufacturers, they need orders to come in so they can keep the factories running. And right now, consumers are making it extremely clear that they're about to cut their spending. And what this is going to do is push more businesses to borrow money. And that means, we talked about this yesterday, the off-balance sheet lending, that is going to surge. I think that is just going to skyrocket here. But if you look at the habits of the consumer, if they don't go out and spend, the risk is all of that inventory is going to get borrowed against. And next thing you know, you're going to face rising delinquencies as businesses can't make their payments. It's going to spiral into defaults, and you can see it could spread into an all-out financial crisis across the banking and the non-banking industry. But what's coming Tuesday could make this a whole lot worse, because this whole situation could be exacerbated by a government shutdown. Let's take a look at this headline. Is Trump's threat of mass firing risks lasting shutdown damage? The Trump administration's threat to fire federal employees rather than furlough them in a possible government shutdown marks a further erosion of job security for a workforce that has already been upended by budget cuts and layoffs. You know, we've talked about timing is everything in an economic cycle, and we've been seeing the U.S. economy continue to slow down. And what is the real impact here? Is the labor market cannot absorb more people. It's barely holding water right now. And so what happens if all of these workers from the federal government go on the unemployment line? Well, that means their spending is going to collapse overnight, and it risks accelerating the downturn. And that is the real risk we're facing right now. Is you can see that consumers have already hit their breaking point. They've said that in the survey data, but the tipping point could come on Tuesday. Now, whether you agree or disagree with this move, if it happens, it's going to have serious economic consequences. But something that could be a plus for President Trump is it might give the Bureau of Labor Statistics an excuse to delay the next non-farm payroll report. And I can tell you, he probably wants that end in a big way. Because per the March plan, all of the Bureau of Labor Statistics, roughly 2,000 employees would be furloughed in a shutdown, except for the commissioner. And if you look at the relationship between sentiment and payrolls, Trump would likely welcome the suspension of this report, because it's not likely to show that the economy is turning around or even plateauing. What we're likely to see is backward revisions show that even fewer jobs were created, perhaps even more layoffs than were expected. We could see negative prints on the backward numbers, and that's a problem. Let's take a look at this chart of the University of Michigan sentiment survey now against non-farm payrolls. And I want you to see the pre-pandemic relationship between the two. As we go all the way back to the 70s, you can see a collapse in confidence led to a collapse in payrolls. You can see it happen into the 91 recession, into the dot-com bubble, into the financial crisis. And my friends, that's exactly where we're at right now. And so you start to understand the big picture here is all of this slowdown is likely to lead to rising building delinquencies and risks they turn into defaults. Because let's take a look at this other chart. I want you to see the relationship between consumer spending and survey data here. You can see very clearly as the survey goes down. Let's look at real retail sales in red, and you can see they already start to decelerate. Then consumers lose confidence, and then, well, sales go plunging down. And you can see that throughout the cycles here. And what we're seeing is very clear evidence that consumers are saying, look, we're completely tapped out here. Our spending power is dried up, and we already know that our dollar isn't going to go as far. But again, the risk is we continue to see businesses looking to borrow more money on an off-balance sheet basis to get through. We've even seen this from consumers. Let's turn to the Federal Reserve Bank's of New York's Q2 household debt and credit report, because they're now saying that household debt has reached a whopping $18.39 trillion in the second quarter. Even auto loan originations are increasing, and at the same time, what are we seeing? That is delinquencies continuing to rise here. So if you see what happens on Tuesday, if the government does shut down and a lot of people are actually fired, well, you can see it's going to be outright economic devastation, because at this point, the average American consumer has reached their breaking point. They've been trying to borrow their way through this, but if they cut their spending, and that's exactly what the data is telling us, because you can look at that long-term relationship between consumer confidence and retail sales, what we're facing is hours are going to get cut, jobs are going to get cut, the delinquency rate's going to soar just like it did during the financial crisis, and the problem is we're going to find ourselves right in the middle of the next financial crisis, my friends. But even in the midst of a financial crisis, there's opportunities in the market. Let's take a look at our Metre strategy here. I want you to see these back-tested results and why an optimized strategy is far better than anything else on the market. Let's take a look, because when you look back over the last 2 years, this is a test on SPY. What you see, total return 71%, beating a buy and hold strategy, a win rate of an impressive 66%, generating 69 trades, max drawdown right around 7.5%. Now I want to show you this compared to an unoptimized strategy. This one run by my buddy Jay Bravo. He calls it the Bravo 9. The problem is the Bravo 9 needs a lot of Bravo help, because you need a lot of other things to make this work. But as you can clearly see, total return 51%, missing buy and hold, win rate nowhere close, and half the number of trades. And look at the drawdown, about the same. So look, you're paying money to get a strategy that doesn't work and requires a lot of other tools to make it work. Now, why is our Metre strategy so much better? Well, now it is not just the Metre strategy, it's the enhanced Metre strategy, combining 9 trading strategies into a single intelligent signal generator and fully optimized for 10-day trading. Generate, as you can see, a success rate of over 60% with fast profit taking. Now, how do you get these trades? Well, you got to sign up for one of my reports. Now, if you want to trade against machine positioning, well, we do that in our CTA Timer Pro report, where we look to see when machines are going to be big buyers, and we position our subscribers ahead of that. But maybe you like to trade those technical signals and momentum indicators. Well, we pair that with a trend and call that Momentum Timer Pro. Now, here's the great part. You get the daily report from whichever report you sign up for. You get all the signals from it, plus the new enhanced Metre strategy trades. You get my opinions on the best trades, risk control levels, a full tracking of all open trades and returns, the weekly update, and here is the best part of all. Whether you're brand new to trading or maybe you're subscribed to my buddy Jay Bravo's report, we're going to give you 30 days to try it out and compare, because once you find out how much better our trades are, there's no other report you'll need. Now, to sign up, all you have to do is grab those links in the description below and use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.